Risk management is one of the most important parts of successful trading, but it's a big topic and every trader approaches it very differently. In today's video, you will hear from Jordan at Tradelicious sharing his personal take on how he thinks about risk. This recent clip is from the Master Risk Event, a special event hosted by the 5ers where real traders share real insights on managing risk in the markets. Let's dive in.
Risk management, I think, might possibly be the biggest buzzword in the trading space. I think everyone knows it, everyone knows its importance, and everyone loves to talk about it. Not many people challenge it. Today, I'm going to attempt to do that. I'm going to go into an area of risk management where most of you probably don't look anymore, and I'm going to show you why it's so important to adapt to it. For those of you that don't know me, I have been trading for a little bit longer than what I want to admit. My age is catching up on me just a little bit, but I actually started out on a more professional side. I went into institutions, some unsuccessfully, some successfully, and attempted my pathway as a career into being a trader. And today I'm going to be talking about position sizing. Position sizing is something most people have down pat. We've got position size calculators, position size. You can find them everywhere. You already know. If I ask you, you probably already know exactly what position size you operate on depending on the assets you trade. This is how I thought for a very, very long time. And then I walked into a trading firm in Melbourne, and I walked to this trading desk and I questioned them on how they did it. How do they go about risk management from a trader perspective? And this trader went through the 3 departments of trading. And we're going to cover all these today in some format. The trading strategy, which we won't dive into much, that's more personal to the trader. The psychology of a trader, which we all know well and truly is incredibly hard to master. And then risk management. And he separated these 3 segments within this business. And what I found out as a trader applying at this firm is the traders themselves had no control over risk management. They didn't get a choice on the position size that was used. All they did was submit orders. They chose where to buy, they chose where to sell. That was it. They didn't get to choose the position size. And I found that fascinating because we all argue time and time again on whether or not you should be risking 1%, 0.5%, doing a fixed lot risk. We always argue on what's the best one to do. Well, these guys completely removed it from the trader's responsibility. In doing so, it's shown them some incredible insights. And today, I'm going to run you through exactly that. I'm going to show you how to step outside of your own skin, look at yourself as a trader in objectivity, and understand how you need to look at your position sizing. Most of you, as I mentioned, will know your position sizes. This is where it's going to get fun. So without further ado, let me go ahead and pull up my presentation, and we're going to run you through what I'm talking about. Now, this is the first slide. What is position sizing? That's a joke, right? I'm not actually going to dive into what is position sizing. I know a lot of you here are to learn the advanced concepts that our experience has given, and that's what I want to challenge. So instead of going through what is position sizing, which if you don't know, don't worry, the 5ers, ABL, Trade the Pool, and Tradelicious have an abundance of resources where you can find this information, or do a real simple Google and you'll get the answer that you need. What I am going to do is introduce you to James and Bobby. James and Bobby here are 2 incredible traders that have put their hand up and allowed me to analyze their trades to apply the best position size management system that I can objectively. James here on the left is a profitable trader. He's actually a really good trader. He consistently drives good returns. Bobby, on the other hand, is a little bit inconsistent. Okay, he's not quite knacked it. He's getting there, but it's not there yet. So what we're going to do is dive into both James and Bobby's system and apply a risk management strategy that makes sense for them. What I want you guys to do at home is to apply yourself. If you are a break-even or consistently profitable trader, from here on out, you are James. When I reference James, I am talking to you. If you're an unprofitable or inconsistent trader, from here on out, you are Bobby. When I mention Bobby, I'm talking to you. Everything that I go through, the processes that I go through, I want you to also go through. I want you to learn from it and go through this process. If there's anything I want you to take away from this presentation, it's how to perceive yourself as a risk manager, not as a trader. So these two have offered up 25 trades of history, which I think we all know is nowhere near enough to actually judge a system. But for the sake of this, we're going to use the 25 trades. Here's James's last 25 trades. Very impressive. Both of these guys trade the same strategy. It's just James is a little bit better. You can see his losses are all 10 pips. That tells me he's got a fixed stop loss of 10 pips. And his risk to reward ratio on those returns are anywhere between 2 to 3%. He's a very profitable trader. Bobby, on the other hand, trading the exact same system, it's not as sexy. He's lost a lot more. His win rate is nowhere near as high, and his risk to reward ratio is lower. They're both trading the same strategy. They just operate on it differently. If we had to look at these guys' equity curves, this is how it will be perceived. So James, the green line, is very profitable. After these 25 trades, he's actually got 349 pips in profit. On you, James. Good stuff. Bobby, on the other hand, struggled a little bit. After 25 trades, he's down 109 pips. What I am going to do today is apply various different position sizing methods to these guys' trades, okay? I am not going to alter a single bit of their strategy. Their results will always be 349 pips in profit for James and 109 pips in loss for Bobby. I am not allowed to change that. All I can change is the number of the position size. And doing so, I'm going to show you the power of position sizing. These are the three, and I've got good nicknames. I say three because the bet on green, I'm not going to lean into too much. But these are the three position sizing techniques that I'm going to share with you. We've got the Daredevil, the Steady Eddie, the Smooth Operator, and the bet on green. The bet on green is something you definitely should not do. For those of you that know me, I probably would have told you about this already. It's not something I recommend, but the mathematics behind it is very important to understand to apply it to something like the Steady Eddie. Say hello to the Daredevil. The Daredevil is like a raging bull. He sees red and he runs. There is no mathematics behind it. It is the same number of lots every single time they trade. They know what they're risking. They know where their stop loss is. They know the dollar value. They run at it. It's a very, very simple process. You figure out what lot you're comfortable with, what losses you're comfortable with. You trade the same size every single time. I've found out through insider information that James and Bobby are both Daredevils. So what I've gone and done is apply this to their trading strategies. In order to do that, I need to estimate the pip value. Both of these traders trade the euro US dollar, okay? And they're both consistently trading with a 10 pip stop loss. So stay with me as we move through here. To work out the pip value, it's very simple maths. It's pip size, which is usually your fourth decimal point of your currency pair, unless you're trading Japanese yen. It's usually your fourth decimal point, times by your lot size in units. One lot, 100,000 units of base currency. In this case, we're going to use 5 lots. That's 500,000 times 0.0001. That gives you $50. So this means every pip that moves, both of these traders either win or lose $50 in equity. Okay, very, very simple maths. So when we apply this to their trading, on the left here, you can see James's profit and loss. On the right here, you can see Bobby's profit and loss. The color coding here really makes it evident on who's the more profitable trader. On the left, you can see James pulls in anywhere between $1,000 to $1,500 per win, and Bobby over here only gets slightly to the upside. He doesn't actually have $1,000 winner at all, but every time both traders lose $500. That's because they're risking 5 lots every single time with a 10 pip stop loss. If we have a look at this in an equity curve, this is James. He's up $17,000. Most people who are in James's position, break even or profitable traders, will now sit back and think, I've mastered it, probably start a signals group. They're good, right? Most people will take their hands off. I'm going to show you exactly what James should be doing, not changing a single thing, but one digit on how he could be making more money. Bobby, on the other hand, is down 5.5, right? Bobby is close to blowing his account. He's stressed and he's close to getting to that point where he wants to do something a little bit crazy. Bobby, we're going to look at this a little bit differently. What we want to do is mitigate the loss. See, in Bobby's situation, and if you're a Bobby, In your situation, our goal is to ensure longevity so you can get enough data to identify the problem areas to increase your strategy. That's as simple as it is. For James, we're trying to mitigate drawdown and increase profit potential. For Bobby, we're trying to mitigate drawdown and increase longevity. That's our courses here. So let me introduce you to the next one, the Steady Eddy, the most used position size management tool in the world. This is the classic reliable method that you've heard everywhere, only risk 1% of your account. How many people have heard only risk 1%? Only risk 2%, only risk 0.5%. These rules that you constantly get. How many people have heard it? I'm willing to guarantee you probably have. I myself am a Steady Eddy. I risk 0.5% per trade. Okay, this is probably one of the most reliable ways of managing risk and your position sizing. And the purpose for that is because it's relative. Okay, it grows with you, it shrinks with you, and that's very important. The idea of calculating the Steady Eddy is very simple. Your account balance time your risk percentage in a decimal point, okay? And you divide that by your stop loss in pips and your pip value. Remember, we just went through how to work out your pip value. Take a screenshot of this chart right here if you want to know how to work this out, or anyone who downloaded the resource from signing up, you'll have all the calculators in there as well. For this example, we're going to be risking 0.5%. That's because what I personally risk in my trading. And I'm going to apply this to both James and Bobby's trading. After doing the mathematics, you can see the green writing on the bottom right of your screen down here. This brings us out at 5 lots. Funny enough, that's the same amount as the fixed lot. The difference with this is we do this calculation every trade. So as the equity changes, whether they win or lose, we recalculate this for it to give us the next position. Let's compare. Let's move it over to the trading portfolio. And as you can see, DD profit here is the Daredevil profit. And now we're moving into the Steady Eddy profit. So this is all in green, right? There's going to be no red. Even the losses are in green, just to highlight where we're looking at the Steady Eddy. You can see that these numbers are already differing compared to the left. In this circumstance here, you can see that James won $1,050, but using this Steady Eddy system, he actually made $1,155, an extra $100. He hasn't changed anything in his strategy. He hasn't altered anything at all. The only thing that I've done is change his risk management approach, change his position sizing. Same thing if we have a look over at Bobby's side, you can see some of these losses, they're all $500. Lose $500 every single time. But when you apply the Steady Eddy approach, as he loses more money, his risk management pulls in. Some of these losses are nowhere near as much. And this scales with the future. The best way to visualize this and compare it is by putting on a chart. Here's Bobby. Once again, the same trades, the same entry, the same exit. The only thing I have done is change his position sizing based on his rules. That's it. These lines look almost identical, but what you do see is the further down we get, the more that they separate. This is only 25 trades. You should be doing this with 2,500 trades. If you can't do 2,500, go 250, meet me in the middle, okay? But the further that this goes, the bigger that gap here is going to become. And the bigger this gap becomes, right, the less money Bobby loses over time. It's very simple math. Then we move on to James. Apply the exact same thing. The difference is not only does it mitigate Bobby's loss, but it actually increases James' profits. See, James didn't do anything different. I just altered his position size. And as time has gone on to the 25 trades, but James has come through here and actually made an extra $1,000 with no extra effort, no change to the strategy, no new indicator. He made an extra $1,000. So Bobby managed to save himself about $150. James managed to make himself over $1,000 just by altering one little thing. Now, I'm repeating myself here, but the reason I am doing this is because I'm going to show you how to compare all of these. And the reason I want you to compare all these is because I want you to objectively look at your trading in the same way. The mission here, my mission here, is to get you guys to go through this exercise, to step out of the trader mind and not think about how you can improve your strategy or change the asset you trade or the frequency you trade, but just purely look at your results from a risk point of view and apply different position sizing techniques. That's all I'm asking. And that's what I want from you. And we're going to move into the smooth operator. The smooth operator chooses his position size based on how wild the market reacts. He uses some kind of volatility tool to understand where the market is going crazy and where it's trading in his prime spot, and he changes his risk accordingly. This is what that fund in Melbourne did. You see, traders would trade based on these units that were made up, coins, essentially. This was before crypto was a big thing. And what they would do is they would trade for points and coins on the system at the fund. And then there would be dedicated risk managers behind the scenes that would analyze their data and choose, essentially trade the traders, choose when they go heavier on risk and when they reduce the risk. That was fascinating, and the smooth operator approach was the way that they did it, and I want to share that with you today. The smooth operator approach uses a volatility indicator. For today, we're going to use the ATR, okay? Not to enter or exit trades. We're not adjusting a strategy. We're going to use it for a different purpose, okay? And it selects different sizes of positions depending on the ATR. This is what that firm in Melbourne did. They looked at the traders, they analyzed who traded better in high volatility markets and who traded worse in lower volatility markets. And then they applied that to these traders without them knowing and enhanced their profitability behind the scenes. There's something in it with the traders not knowing. As retail traders, we don't get someone behind us analyzing it and altering our risk for us. Unfortunately, it's just us, okay? So if we go ahead and have a look at a trading view chart, for example, let's just go ahead and get the ATR in here. This is the ATR of 200 on Euro US dollar. We know that both these traders trade Euro US dollar in the same trade. All right. You can see this is averaging up at 0.17 all the way through. We get in and around the 10s, the 14s. What is really important is to have a look into this and really understand where you perform best. Do you perform better? Look at your trade history when your ATR is much, much higher, okay? Or do you perform better when the ATR is slow and steady and it's much, much nicer? Who knows, right? That's up to you to go. What I did was I looked back at Bobby, okay? Now, Bobby here had an interesting pattern. My job was to identify this pattern as a risk manager. And what I found is Bobby, he had a 60% win rate when he just traded when the ATR was less than 14. If he just traded lower volatility markets, Bobby would have made money. He would be a profitable trader. Fascinating. But my job's not to tell Bobby to not trade those higher markets. Bobby trades his strategy. I'm not allowed to touch the strategy. All I'm allowed to do is change his position sizing. So then I went and looked at James and I looked for the same thing. Is there a pattern between the ATR and James's outcome? James's profit and loss. Is there a pattern? Not as much. You see, most of James's trades were at 14 or under on the ATR. This could be where James is performing better than Bobby, perhaps. But that's altering a strategy. I don't want to do that. What I did notice is anything above 14 ATR, James lost. There was only 3 circumstances, small track record, but he lost. So I set some new rules. I automated their position management. Whenever the ATR was at 9 or less, they're allowed to risk 0.75% of their account. Okay. When it's between 10 to 14, they're allowed to risk 0.5%. And when it's at 15 and above, they're allowed to risk 0.25%. I want to make sure that everyone understands these numbers are theoretical. I am showing you the theory of how this works, not something that you should use. This is based on these traders' reports. You need to have a look into your traders' reports and figure out what works. Okay, so I applied this system to all of 25 of their trades, so 50 trades all up, both for Bobby and James. And what I found was astronomical. See, applying this smooth operator risk management system, once again, not changing the strategy, same trades, same pip outcome, same process. Completely different profits. If we have a look at Bobby, this is now his equity curve. He's halved his loss. Didn't do anything different. Still traded, still lost the same amount of pips, but by looking at his position sizes from an objective point of view, he's managed to halve his loss. James, on the other hand, increases profits by about 40%. Same process. Every single one of these portfolios used the exact same entry, the exact same exit, the exact same strategy, and the exact same execution. The only difference was the position size. Many people overlook it. When they say, oh, I've got my risk management down pat, they go, I risk 1% per trade, I'm fine. I don't need to look at risk management anymore. What I really want to lean into today is show you the power of revisiting the things you learned as a beginner. This is different. You don't look at the trading. You don't look at your trend lines. You don't look at the support and resistance. You don't look at your entries and your exits. You look at your performance, and you trade your performance to either keep you in the game longer or to maximize your profits. For James, we took him from a $17,000 profit from 25 trades to a $27,000 profit in this circumstance. Okay. If the smooth operator is not you and you prefer a steady Eddie, awesome. We increased his profits by $1,300. For Bobby, we took him from losing $5,500, gave him the steady Eddie and brought that into 53. Okay. We applied the smooth operator. Now this doesn't always work for everyone, the same system, and it brought him down to only a $2,000 loss. Analyzing your data to see which risk management system fits you is paramount on making sure, if you're Bobby, you're in the game long enough to learn, or if you're James, you're not giving away profits. Okay? That's the end of the serious part. That's the real message I wanted to send you. Now I'm going to share with you something called the bet on green. The headline here is very simple. It's just fun. Don't actually do it. If you're a James, this is going to be a great tool. It is going to boost your confidence through the roof and you're going to feel like an absolute champion. If you're a Bobby, this is going to be a real punch in the face. And I mean it. If you're not quite there, this is going to show you how far off you are. But I want it to be used as a motivator to do the right things to get where you need to be. This is the Kelly criterion. Okay, the Kelly criterion is a simple mathematical equation which shows you the absolute pinnacle that you can risk. I mean the tippity top. I mean, if you're a jet pulling G-force, if you go 0.1 G bigger, you blow up. That is what the Kelly criterion does. And I'm hoping that that gets your curiosity. This shows you the maximum risk that you can possibly take to get your maximum reward. I'm hoping that sinks in. Get the curiosity. What is the maximum? You ever sat there and gone, oh, let's just go crazy. What is this? This is what tells you your maximum. Now, the reason I'm doing this exercise is not so you go and do it, because that'll be very irresponsible, but because the traders who are you, James, you're going to learn a lot about your system and a little bit more about your position management. For the traders that are Bobby, it's going to give you the slap in the face and the kick in the backside to do the right thing to get to where you need to be. I went through and had a look at all of James and Bobby's trades. I needed a couple things from this. I needed their win probability, their average win, their loss probability, their average loss, divided by their average win. So I have a look through their data, and guess what? I'm really quick at maths. I've even done it for you. There you go. Average win for James is $1,200, give or take. All right, his win percentage is 68%, which as a paramount means his loss percentage is 32%, and his average loss is $500. Simple maths, great trader. The average win for Bobby, on the other hand, was $507, win percent of 28%. That's not as good. The paramount opposite to that is obviously 72% with an average loss of $500. It's time to calculate the Kelly percentage. Let's start with James, because James is profitable and it's nice to see what happens. James, let's fill in the document here. You can see his 68% win rate times by his average wins here. His 32% loss rate times by his average loss divided by his average win comes in at 0.5526. For everyone at home, that means, according to mathematics, in James's trading system over the past 25 trades, he could have risked 55.26% per trade. Every mature trader in here just went, there's no way you ever do that. Correct. There's no way you ever do that. But just for fun and maths, it does suggest 55.26%. That alone for James's last 25 trades would have brought him about $354 million. All right, outrageous. How do you actually use this as a normal mature trader? The Kelly percentage is a fantastic way of knowing what your profitable factor or your profit factor is, but also, okay, how you perform as a trader. If you go through and you do the Kelly percentage, here's the calculation for it. Go do it yourself, okay? Not based on your projections, but what actually happens. If you go through and do this calculation, divide the answer by 100. That is how I do my steady Eddie. I am a steady Eddie trader. Okay, I use the Kelly percentage, or what I like to call the bet on green, taken from roulette, and I divide that by 100, and that makes my average risk. So there's a good little trick for you James traders in there. For you Bobby traders, let's do the same calculation. As you can see, we've got the average win rate, which is 28%. The average win is 507, 72% loss rate, average loss of 500 divided by the average win, which is 507.14 once again, same as above. That gives us a negative 0.4299. That means the maths behind Bobby's system tells him to risk negative 42%. It is so far out of the mathematical equation that it's telling Bobby he should be risking negative 42%. Bobby needs to bring back 42% before he gets to a break-even point. Let that sink in. Now, that just seems detrimental, right? It's this crazy number that I've just thrown out in the maths that we've done. But the reason I'm sharing that with you is because it can highlight your profit factor and it can highlight your performance. All of the calculations I've done today are not projected outcomes. They are previous outcomes. I have the exact dollar value, the exact pip value that comes in. If you're a James trader, do this. Learn about your system. Do not do this. That is outrageous. Divide that by 100 and consider utilizing that. If you're a Bobby and you get a negative, put it on your wall, put it above you, and use that to highlight the problem areas within your trading system. Is it your execution? Is it the strategy? Probably not. Most times it's not the strategy. And really, really jump in.